you say that the markets are looking for a catalyst. Is that the market's looking for a catalyst to keep going higher, or in fact, is it the other way around? Are they looking for a reason to correct if they get even the slightest bit of hawkishness from Jay Powell?
It could be either. They are looking to Jackson Hole. This week was all about Jackson Hole, and they're looking to that for direction. Look, I think the rhetoric's going to be pretty tough. Even a dove like Neil Kashkari, Minneapolis Fed president, he's turning to a raging hawk. But it all begs the question, what's driven the rally off the June lows? I would look to futures pricing in Fed funds and where they'll be next year. Right or wrong, what's priced in right now is a terminal rate of about 3.7%. But it's the back half of 23 that's the most interesting, Wilford. Right now, investors are pricing in actual rate cuts. We'll see if Jay uses his comments tomorrow to change that view.
And as we stand, David, do you think the risk is to the downside for markets because they're expecting a slightly more dovish tone from him, or in fact, the other way around?
Unknown at this point. We've had a pretty strong bid off the June lows. I think the lows are in for the year. That doesn't mean that we can't go down from here or that the cyclical bear market is over. But we're going to need to see something we haven't seen yet to break those lows at this point. My biggest concern right now, what markets aren't pricing in, is energy. Saudi Arabia's oil minister floated a trial balloon this week saying that OPEC may be forced to cut production. And this is after President Biden made a state visit in part to secure additional output. The administration is not going to be able to continue selling 1 million barrels a day. That has to end by the election. We're depleting the SPR. It's at dangerously low levels. And the only way you can fix that is to buy more oil.
In terms of the outlook for the U.S. economy, clearly a lot better than that of Europe. Though in the last month or so, have we seen the way in which negative headlines about Europe and the UK's economic outlook can infect market sentiment in the U.S., even if the U.S. economy remains more resilient?
Yeah, it can. Look, we're still a global society, like it or not. PMIs around the world have been falling. They've been falling here. They're certainly falling in Europe. They've been falling in Asia. You know, we're just coming out of a recession right now as we speak. We're looking at about 1.5% GDP for the third and fourth quarter. We could easily slip back into recession next year if we don't make the right moves. We got a get out of jail free card for this past quarter in terms of earnings. That's just about over. I think the next catalyst is actually the third quarter earnings season in October. We're going to need to see an improvement in some of these numbers to justify the exposure that investors have put on this quarter.
So sum it up for us, David. Are you buying any U.S. sectors in particular right now where they're attractive, or more likely taking any profits in some that have bounced too hard since those June lows?
I'm out of money, Wilford. I'm all in at this point. I'm fully invested across the board. I'd say I'm probably market weight for most of the sectors at this point. My one overweight right now is still energy. The free cash flows are just, I can't deny it. You know, it's just too good to be true. I've got to stay with that trade.